Gold is on all-time highs. That's the end of the story for me, right? Why do you need to fight that? Well, I always say this about all markets. Why would you ever sell a market that's on all-time highs?
Hmm.
It just seems silly to me, right? You're fighting the tape. You know, who cares? You know, everybody wants to think, and overthink. But it's pretty simple. When a market now, does that mean that gold can't hit its all-time high right here and now and top today? It could do that, clearly. But look for a signal first. You know, the market gives hells all the time, right? And closing at an all-time high is not a tell that the market's going down.
Hey guys, welcome back to Capital Cosm. Today I've got Jason Shapiro, hedge fund manager, and special shout out in the Market Wizards book on chapter 2. He is the contrarian. So happy to have him on. Jason, thank you so much for coming on.
Thanks for having me.
Before we get started, guys, I'd like to remind you to hit that like and subscribe button if you haven't already, and also check out our Substack, capitalcosm.substack.com. The Substack version of this interview will be posted in the pinned comment down below, as well as the description box. So be sure to check it out to get an ad-free full experience of this interview. There will be an exclusive section posted exclusively for Substack members, so be sure to check that out. Jason, let's just dive right in, my friend. For people who may be coming across you for the first time, kind of give us a background. What is your origin story? What got you into investing and becoming a hedge fund manager and all that stuff? Who is Jason Shapiro?
So, you know, I started trading when I was had my first job when I was like 21, 22. I was living in Asia, working for a bank, kind of bored, got involved in trading sort of Hang Seng index futures. And the journey just kind of went from there. You know, I enjoyed it. I enjoyed the idea of it. I went through a lot of ups and downs and made a bunch of adjustments and really saw this whole thing as a puzzle that I wanted to solve, which can never be done clearly. But if I could get closer to solving it as time goes on, that's good. And that's what I've been doing now for 30 plus years.
Gotcha. Well, let's get your take on the economy. Let's get your take on the economy and the markets in a macro sense, and then depending on how that conversation goes, we can kind of hone in on specific topics that we come across. So, what is kind of like your broad view of the economy as well as the markets at this moment? We do see things like the yield curve uninverting. If you could walk us through what that means as well, that'd be great.
So I will preface this by saying that while I enjoy macroeconomics very much, and I can sit here and talk macro just like the next person can, I really don't think that my edge is necessarily in macro. I don't make trades based off of my macro view. Okay. So take that all with a grain of salt. But what is my view? You know, I am biased to the idea that macro is really a function of liquidity, right? As Milton Friedman once said, you know, inflation is always and forever or something a monetary phenomenon. So I think it's all of this stuff is based on liquidity, meaning money supply. And it's not just money supply, which we can watch the growth and fall of money supply. But the hard part is it's also the velocity of money supply. You know, how many times that money supply turns over, which we can't watch, you know, we can't measure until after the fact, right? We can say, hey, here's GDP, here's money supply. So how many times did that money supply turn over? We can only do that later, right? So I believe it's all a function of that. And from a macro point of view, that's what I watch. So can we say that money supply or liquidity is failing here? With the S&P within whatever 1% of a new all-time high and gold on new all-time highs and housing prices on all-time highs and all that. To this point, I don't think that we can say that. So if that's what's driving the asset prices, then I don't see that as of right now, having come to an end. The asset prices are telling us that that's not coming to an end. So what you have here is a no shortage of liquidity, and yet the Fed is looking to cut rates,
Hmm.
which in theory increases liquidity that much more. And this is why you see gold, going to new highs, right? They're cutting rates into a environment where there's plenty of liquidity. So that is asset positive, if you ask me.
Is this Ludwig von Mises's Crackup Boom? Where
I'm
asset
sorry?
price is this the Crackup Boom that Ludwig von Mises talks about?
I don't know who Ludwig von Mises is. I don't know what does Crackup Boom mean?
So, if you recall back, like in the Weimar Republic, asset prices went sky high, but they didn't keep pace with inflation, right? So, when
Right.
you have this, I guess this inflationary environment, and that's up for debate, right? Some people say it's deflationary, et cetera. But when you have something like this, asset prices benefit the most, even though it's really your currency that's being devalued. Is that what's going on?
I think that's probably what's going on. Yes. I don't really see the inflation thing as look, the inflation thing happened because of COVID. Okay. We know that, right? COVID shut down production, shut down shipping, shut down trucking, shut down everything. So clearly there was inflation. And now we're back to normal
Mm.
inflation, 2, 3% a year, whatever it is, right? I don't think that had anything to do with the Fed personally. It just had to do with the COVID thing having to work out of the system over time, which it's done. So we're kind of back to normal there, right? And now they feel like looking at the inflation number and looking where Fed funds are that they're over tight. So they're going to loosen. But um, I think cutting rates into, all-time highs in these asset prices, uh, is interesting to say the very least.
Why do you think they haven't backed off, despite the market being as strong as it is? The Fed, that is. Why haven't they backed off from cutting rates?
Have the Fed not backed off or have the analysts not backed off?
Mm,
The Fed has not
good
been
point.
that aggressive in saying that they are going to be cutting rates so aggressively. The market likes to say, every time the S&P goes down 40 points, it's like, oh, we have to do 50 basis points or whatever. I think that people are somewhat out of their minds. Now, do I think that they'll cut 25? It certainly looks like they'll cut rates 25 in September. But I don't know why it's necessary. But I don't run the Federal Reserve. They hopefully know more about this than I do. But I I can't see it being very bearish for asset prices at this point.
Mm. Yeah, I mean, I do recall back about a month ago when we had the yen carry trade unwind. I mean, people were calling for like a 50, 75 basis point emergency cut. And, look at us now.
People are ridiculous. So, you know what I
Yeah.
mean? The S&P goes down for 3 weeks and like, oh my God, the world's ending. Like it's such a ridiculous thing, really, in my view.
Yeah. Yeah. This kind of like this fragile mindset that's been built into investors over the years with the easing environment kind of, I think, kind of precipitated that. But let's go ahead and look at gold for a bit. You did mention new all-time highs in gold. Um, Gold sitting at $2,600, a little over $2,600 at the time of this recording. Silver is a little over $31. And what do you make of this? Is this simply, precious metals buyers, or what's driving this? Are they being solely driven by, promises of a rate cut or something else?
Liquidity. I think it's a
No.
function of liquidity. That's really what I think. There's plenty of liquidity out there, and now they're about to provide more liquidity. So, where would you expect gold to go in that situation? Gold is the ultimate, really, maybe gold and maybe Bitcoin are arguably the ultimate liquidity driven assets because they don't really have any utility. I guess gold has some, but they don't really have any utility value necessarily, but they're the ultimate liquidity asset. And clearly gold is the ultimate devalue fiat currencies asset.
Hmm.
So I think that's why gold keeps going up. more and more money has to get allocated towards gold in this environment.
Yeah, I just find it interesting because one of the more reliable indicators of a weakening economy, a recession, et cetera, is the unwind. Sorry, not the unwinding, but the uninversion of the yield curve, the 10-2 spread. We are above zero now, where the 10-year is back above the 2-year. What does that imply?
So if in fact what I'm saying has some truth to it, okay, then what does that tell you? Let's say that there's plenty, let's say it's true. I don't know, but let's assume that it's true, that there's plenty of liquidity in the system, right? And yet they're cutting rates into that anyway. Well, the yield curve, obviously, the short end is going to stick with what the Fed is doing by definition, right?
Right.
So if they're cutting, then short rates are going to go down.
Hmm.
But long rates, have nothing to do with that, right? Long rates are a function of future expectations into growth and inflation. So if they're cutting rates, if they're providing more liquidity into what is already a liquid environment, right? Then wouldn't that increase expectations for either growth or future growth or future inflation? I would argue yes. And so that is the yield curve right there, right? That's the short end
Interesting.
sticking with Fed funds, and the long end starting to discount the fact that there's probably more either growth or inflation or both in the future coming because you're adding liquidity to an already liquid environment. That's what I think is going on.
Is there precedence for this anywhere in history?
I don't really know. There have been times where they've cut rates into new highs in the stock market, certainly. And that has been sometimes bullish and sometimes bearish. I don't think there's any definitive answer to what that means, nor do I believe in that kind of stuff anyway, because each situation I think is unique to itself, right? You're not going to compare right
Mhm.
now to 2007. This is not the same environment we were in 2007, right? Um, so I'm not the greatest on what's the whole, how many times have they cut rates into new highs and all that? I don't know. I've seen some statistics on it, but to me, they've all shown nothing to tell us what it means for where markets are going to go, which ultimately, as traders, is what we care about. Who cares about the economic stuff, really? We care about where the markets are going,
Right.
This assumption that the markets have to go down if the economy weakens, I don't know that that's necessarily true. It would make sense, but do markets make sense? I don't think they do. If they did, then it would be kind of simple, right? So I don't really know. I'm not going to say that gives me any predictive power here for what's going to happen in the markets.
You make a very strong point here, Jason. Oftentimes people conflate the economy with the market. And rightfully, you pointed out that the two are not one and the same. And the market can keep going its own way, independent of the economy. Of course, there's a relationship between the two, but who's to say how strong the strength of that relationship and to what extent that relationship occurs? Uh, Tying it back to gold, as
I
traders.
just got to say, I saw an interview one time on like CNBC. This was years ago when Maria Bartiromo was still on CNBC.
Mm,
And she did an interview with Warren Buffett, who, look, everyone says is just the greatest investor of all time, right? And she said to him, it was a little excerpt from her interview. She said, "What do you think the biggest mistake people make in the markets are?" And he said, "I think that people try to correlate short and medium term moves in the economy to short and
mm.
medium term moves in the stock market. And I think that is the biggest mistake people make." Warren Buffett said that, not me. Okay. And then she's like, "Okay, see more of my interview with Warren Buffett tonight on my show or whatever at 8 o'clock." And then they cut back to their live programming, which was this section, bulls and bears. And they had one guy that was bullish and one guy that was bearish. And they say to the first guy, "So what do you think about the markets here?" He goes, "Well, I think the economy is doing this and that. And therefore, I mean, he just said, Warren Buffett just said that's the biggest mistake people make." And the guy comes back and says exactly that.
In one ear, out the other.
I mean, he maybe didn't even hear it, you know what I mean? Because he was in the studio or whatever. But I thought it was so telling and so funny at the time. Um, that's what people do. So anyway, go ahead. Sorry, I didn't mean to interrupt you there.
No, that was a great point. I was just going to say that looking at this gold market as a trader, or maybe even as an investor, we've made some pretty decent gains so far in gold on a year-to-date basis. How much runway do we have left in this precious metals bull market for both gold and silver? And let's talk about it in terms of the short term as well as the long term. Let's kind of answer that question in two fronts.
Again, my ability to predict the future is as good or bad as your ability or anybody else's ability, right? Which is to say, I can't do it, right? But let's just keep it super simple here. Gold is on all-time highs. That's the end of the story for me, right? Why do you need to fight that? Well, I always say this about all markets. Why would you ever sell a market that's on all-time highs?
Hmm.
It just seems silly to me, right? You're fighting the tape. Who cares? Everybody wants to think, and overthink, but it's pretty simple. When a market now, does that mean that gold can't hit its all-time high right here and now and top today? It could do that, clearly, but look for a signal first. The market gives hells all the time, right? And closing at an all-time high is not a tell that the market's going down. Closing at an all-time high is a tell that the market, if anything, is going up, right? But if you're looking to sell it, wait for it to fail on some kind of liquidity news. It's being driven by liquidity. So wait for the market to not go up on some liquidity news. Let them cut rates 50 and let gold not go up on that. And then you can say to yourself, well, gee, maybe that's it, right? Maybe the market's not telling me that it's not going up anymore. But until then, what's the point in getting in the way of it? I mean, it just seems it seems silly to me, and fighting the tape people love to do. They love to try and outthink the market and all that. And it doesn't work over time. You can get it right once in a while, just like you can call heads and flip heads once in a while. Doesn't make you a great coin flip predictor, right? It just means you had a 50-50 chance, right? I would argue that when a market closes on all-time highs, the chances are probably better than 50-50 that it's going to continue higher, which is why people trade breakouts, right? Which is why momentum systems have big gains. Not all the time. Sometimes they chase the momentum and it fails and all that. But over time, they can get very big gains in momentum systems. And that's why, because I think the chances of a market continuing higher when it closes on all-time high is probably better than 50-50.
Hey guys, quick pause. I won't take too much of your time, but if you're looking to add into your gold and silver stack, please consider Miles Franklin. More specifically, email them, info@milesfranklin.com, and tell them that Capital Cosmos sent you in the subject line to unlock special pricing that you won't find on the website. In the unlikely event that you don't like the prices, you could always not buy. There's no commitment necessary, but I do recommend Miles Franklin for a number of reasons. The customer support is top notch, the prices are great, and I know the people there. Great people all around. So with all that said, let's get back to the video. Thanks, guys. Right. Speaking of tells, one tell of being in a precious metals bull market is when the price of silver begins to outperform the price of gold. We've yet to kind of see that, although we do have silver at $31 right now. It did jump significantly in the past couple of days. But, how are we in a precious metals bull market if silver is not outperforming gold in this case?
I don't know if silver outperforming gold necessarily is the definition of us being in a bull market. If you tell me that you've done some tests and you've seen that and that's proven, then I'll take your word for it. I don't know that that is a definitive answer for what a precious metals bull market is. But are we in a precious metals bull market? Like I said, the gold is on all-time highs. So we're certainly in a gold bull market by definition, right?
Mm-hmm.
Silver, look, people argue it's more economically, related to the economy, whereas gold is not, and the economy is weakening, so therefore silver is underperforming. I think that's the argument people make for that, but certainly the last couple days, silver is really starting to outperform here, right? So I can't say that we are not in a precious metals bull market. We clearly are. By any definition that you want to make. We're in a bull market, right? And like I said, I could end tomorrow, but it didn't end yesterday, right? So that's a bull market. It's in a bull market, you know. Bull markets end, yes. When bull markets end, they will not always on the exact high, although sometimes on the exact high. It will give you a tell. It will stop rallying on news that should make it rally, right? It will give you that tell. You come in today and you say, "Oh my God, I'm long gold. Oh my God, look at the news today. That's super bullish gold." And gold ends up down that day. Then maybe you say to yourself, "Okay, I either got to get out of this, or I need to reduce, or I need to hedge, or do whatever you do to reduce the risk in your portfolio." But until that day, I don't see any reason to be a wise ass. You know?
Yeah. Yeah, I mean, I ask it because silver is on, is further out the risk curve relative to gold, in much the same way that the gold miners and the silver miners as well. I mean, they're even further out the risk curve, and when you look at this stuff historically, you see capital flowing into these assets when you move into different phases, into deeper phases of like a precious metals bull market. That's what I'm asking is I guess the essence of my question is, essentially, is this bull market just getting started if we still haven't seen silver and the miners get some of that same love that gold has gotten? I think that's what
I've never personally been a big believer in investing in gold miners.
Mm,
Um, these are horrible businesses with horrible return on equity, right? It takes a lot of money, a lot of equipment, a lot of land, a lot of labor, a lot of political stuff that goes on to pull gold out of the ground, you know? Um, if you're bullish gold, be long gold. Why even fool around the miners, to me? Or if you're bullish silver, be long silver. Why fool around the miners? It's been proven they're such horrible businesses. Their return on equity is horrible. So I don't even know why fool around in that. I think that's why I believe that's why they consistently, not consistently, but have been for a long time, been way underperforming the metals, right? The metals is a macro story here, right? The miners is a much deeper story than that. If you really talk to and listen to people that are in that business, right? It's a very, very difficult business.
yeah. Well, I want to pick your brain as a hedge fund manager. I have guests, that come on this show that are just kind of like, strictly TA, technical analysts. And then I'll have guests that don't even look at TA. They're more fundamental analysts. So when you're making your decisions, do you engage in both TA or fundamental analysis, or do you typically kind of lean on one more than the other?
So my process, I trade a very strict process, right? The way it works is I am looking to fade mass consensus. So I measure mass consensus. When my measurement is telling me there's mass consensus here, like everybody's super long or everybody's super short, I'm then looking to go the other way. But I don't go the other way just because they're super long or super short. I'm looking for the market to confirm that, which I would suggest to anybody, no matter how you trade or what you do. Don't do anything until the market confirms your belief system, right? If you think the stock market's going to crash, great, but let it confirm that first. You know what I mean? Like, don't be shorting all-time highs every day just because you think the market's going to crash. That's what people were doing all last year, right? That'll kill you over time, right? So anyway, so I'm looking for this mass consensus, and then I'm looking for the market to confirm that. So for me, what confirmation means is like I was talking about. Let's say I was looking to get short gold here. Let's say I read my stuff tells me the market is way too long gold here. Okay. Well, I'm not going to short it today based on that. I'm going to short it when the market confirms that. And what confirms means to me is, like I said earlier, you get some piece of super bullish news gold, and gold can't rally on that. So is that technical analysis or is that fundamental analysis? It's not classic fundamental analysis.
Mm-hmm.
Classic fundamental analysis would say, look how bullish that news was. and the market didn't go up, so there's an opportunity to buy it here, right? My fundamental analysis is look how bullish that news was, and the market didn't go up, and everybody is super long already, so I'm going to short it here, right? Because markets do top, obviously, at the most bullish point, and markets do bottom at the most bearish point. Markets don't top on bad news. Markets top on good news, right? And markets bottom on bad news. So you tell me, is that technical analysis? Is that fundamental analysis? I think it's some kind, it's not classical technical analysis either. I'm not selling a head and shoulders or a
Right.
breakout on a chart or something like that. I'm not doing that either, right? Um, it's a form of technical analysis, I guess, because it's sort of like a reversal day candle. What do they call those candles? Reversal day candle type of thing on a fundamental news that should have been up, right? So I'm looking at the fundamental news. I'm paying attention to the fundamental news so I know what's driving it and I know where the market is going to fail on that good news, right? I have to know what the news is to know if it's a market failure, right? So I am doing some fundamental analysis based on that. And I'm doing some, I guess, technical analysis because that's really just a technical pattern right there, right? So I guess in some ways it's a combination of both, and in other ways it's neither, you know? Um, I don't really sit here and pretend to say that I know, you know. If it works for you, I have a guitar teacher that says this to me all the time. If it sounds good, it is good, right? So if it works for you, then who the hell am I to argue? I'm gonna sit here and say, oh, technical analysis is a bunch of garbage and it's a bunch of this and that. Yeah. Okay, maybe I think that, but if you're making money doing it, who cares what I think, right? But you have to be honest. If you're not making money doing it, and I mean over time, I'm not saying, hey, this one trade was a breakout and I bought it and it worked. The question is over time, are you making money doing it? And if you're not, well, then maybe you need to find something else, right? That's my only argument with all this stuff. If it works, it's great. And if it doesn't, well, then it's not great. That's what I think.
Yeah, people get enslaved to these philosophies, and in a way, they kind of pigeonhole themselves into one methodology versus the other. But these methodologies, these ways of doing things, they're there to serve you, not the other way around. And
That's right.
so, very well put there. We did talk about trying to time tops and trying to time bottoms and all this stuff. And in many cases, it's kind of a losing battle. But in one area where we do appear to be at a significant low is if you price commodities relative to the market, i.e., if you take the commodity index divided by the S&P or something like that. If you look at it that way, price in the S&P, commodities are super cheap. Although we've had a pretty distinguished run from 2020 up until 2022. And since then, we've seen a pretty, not a devastating correction, but a decent correction, over the last 2 years. And, you could say we've been kind of moving sideways for about a year now. How do you see commodities overall? Do you see this capital rotation that's often talked about, where we could expect to see a rotation away from the broad market into the commodities sector?
I don't really pay attention. I don't really believe in that type of analysis. You know,
Mm.
any time series that you look at, right? Be it commodities to stocks or just be it an individual asset or whatever, has times when they get oversold, right? And sometimes that's worth a buy, and sometimes that's not. You know what I mean? Just like anything else. I don't see any historical proof that just because something has underperformed for X period of time, that makes it a great buy necessarily. Clearly, when a market bottoms, will usually bottom off of some kind of oversold reading, right? But there's plenty of times where you get oversold readings and it just stays oversold for God knows years, right? Weeks, months, years, right? So I don't know that that's, at least for me, the way to analyze it. Do I think that money is going to flow out of stocks and into commodities? I don't know that money flow really works that way. You know, um, do you know anybody who does that? Because I don't. I know people who trade stocks. I know people who trade commodities. I don't know people who say, "Oh, I'm going to flow out of stocks and into commodities, or out of commodities and into stocks." There might be individual stock players that, for whatever reason, get bullish commodities and therefore start buying the energy stocks or the gold stocks or whatever. But I don't really know that massive amounts of money flow out of one and into the other. I've never seen that, you know. Um, but if they do, certainly that could be a big move, because you take 10% of the money that's in, Nvidia, Apple, Google, and whatever, Microsoft, and put that in gold, and you're going to have a freaking move, man. I can promise you that, right? Because the gold market can't, how would it be able to absorb that kind of money, right? Without it going up a lot, right? Um, from a personal basis, I did get long the energies just this week,
Hmm.
the first time, but that has nothing to do with my view on any of that. It has to do with my process. People just got way too short the energies. We had a piece of bearish news come out um, on Wednesday, specifically the inventory report. And after going down on the back of that report, the stuff rebounded and closed up. So I get long there. Does it work? I don't know. Less than half my trades do work. But what I know is it just gives me a good risk reward. If it works, it'll work to the tune of, 5 or 6 times. And if it doesn't work, I'll get stopped out and I'll lose one time. And really, that's what I try to do. And truthfully, I think that's what trading really is. We can have all these interesting discussions about the markets and what's this and that, but all trading really is trying to get into situations where you're getting paid five and lose one, right? And have that work 40% of the time. If you can get paid 40% of the time and lose 60% of the time, your P&L is gonna treat you very, very well. And that's really, to me, all this is. All this other stuff is very interesting. Like I say, I love macroeconomics. I love talking about it. I think it's hugely interesting. I have my theories. Sometimes they're right, sometimes they're wrong, but I don't think that's the way to make money. The way to make money is somehow determine where you can get into these 4 or 5 to 1 risk reward trades. And like I say, some people do that. I do that by trading market turns. That's me. Okay. I'm buying panic. I'm selling euphoria, hopefully, right? That's what gets me into those trades. But some people do what's essentially is the opposite, which is they're buying breakouts or they're selling breakdowns. Okay. I think that can also get you into a very good risk reward trade, especially breakouts, right? Bull market breakout. I mean, it's proven that, William O'Neill and all these guys, that's what they do. And provided you're in a bull market, if you're buying breakouts to the new highs, you're buying the strongest thing in a bull market, that gives you great risk reward over time. But clearly with that, you got to be careful, because you got to know when the bull market ends, because that's when you're going to get housed and that kind of stuff, right? And obviously that's difficult to do. But, anyway, the point is, to me, that is what trading is. And that, I think, is the most misunderstood thing in this entire game, right? People think that trading is about trying to predict the future. And I don't think it's about that at all. I think it's just getting into positive risk reward skewed trades over time and then being disciplined to those trades. That's what trading is for me. After 35 years or whatever it is, that's all it is to me. The rest of it is all just fun and interesting conversation.
Essentially identifying asymmetry and
Yes,
letting your winners run and make up for your losers.
that's it. Cut your loser, let your winner run. Try to identify some kind of asymmetric situation. And that doesn't mean it works all the time, but it means when it does work, you should get paid a lot more by definition if it's asymmetry, right? You should get paid a lot more than you lose. That's all this is.
Yeah.
And
And you essentially can hedge yourself just by your position size. So oftentimes when people just like go really deep on one big position, and it may be an asymmetric trade, but asymmetric trades don't always work out in your favor.
no, they don't.
So you might want to, position yourself in multiple, diverse allocation of multiple asymmetric trades.
I
And
mean,
so, like
ultimately,
you
that's
pointed
what you
out,
want. That's what you want to do ultimately, right? Ultimately, that's what you have to do. Because they're not all going to work out in your favor. Like I say, less than half of my trades work, but that's okay, because the payout is so much more than the loss. So, and over time that will work, and hopefully it continues to work, but I have losers all the time.
Okay. Well, you did make mention of the oil market, or the energy market, I should say, but let's hone in on the oil market. What's your general prognosis of the oil market? It's seems to be flirting with $70, although it did break below it earlier this week. I think it's like it's 69 last time I checked earlier today. I don't know what it's at now.
Yeah, 68, 69 around there, depending what month you're looking at.
Yeah. What do you make of the oil market? You did say you went long energy this week, so
I
what's your
did,
opinion
which
there?
again doesn't mean that it's going to work, but it just means that I think the risk reward is in favor of being long here.
Hmm.
And how long that lasts and, is not really up to me. It's more up to the data. I've got long because I think people have gotten too short. How long it takes them to get out of those shorts, I have no way of knowing. Sometimes my trades last 3 weeks. Sometimes they last 3 months, and sometimes they last 9 months, right? It's kind of up to them. If I'm buying because people are way too short, well, then I'm getting out when they are no longer way too short, right? And I don't know what they're going to do. I just sit. If the trade works, I sit and I wait until they're no longer super short, and then I just take what hopefully will be my profit. Or if it makes a new low, well, then I stop out. I take my loss. But that's how my trading works. So here, I like it. I mean, we know the story, right? Based on this whole China thing slowing down and, and demand being so much lower and because of that and all that. We know that. So what's new there, right? I guess China could get weaker. I guess the US economy could get weaker, European, and that could make demand. But then, you get OPEC cutting supply too. Like, we don't know which one of these things is going to happen or what combination of all these things are going to happen. So to me, it's just, again, risk reward. You're going to ask me what I think of the oil market. I'm no expert in the global supply demand of oil, I can tell you, right? I just know that the positioning is way too short here. So the risk reward for me is skewed the other way. I wish I could give you a more intelligent answer. I wish I could tell you I just got off the phone with, the CEO of ExxonMobil and he told me blah, blah, blah. But the truth is, CEO ExxonMobil doesn't talk to me. So,
Well, also in the energy sector is uranium. Uranium has been taking a beating over the last several weeks. If you look at the URNM ETF, it's down to about $41, down quite significantly. I think at the high at around 110 a few months back.
geez.
Do you keep track of uranium at all?
I don't trade it, but I do watch it because it makes the news a lot. I mean, I would argue it's kind of typical. The whole nuclear thing started hitting the cover of Barron's and the cover of Business, and it became very obvious that that's where we need to be going. These tech billionaire people are investing in these mini nuclear plant type of things so that they can get the energy, so they can get these, whatever they call them, data centers, power and all that stuff. It became very obvious that that's the place to be, right? So once it becomes obvious, it gets crowded, and it goes the other way, to get people out. When it looks like easy money, there's no such thing. It's very, very rare you get easy money, right? So when it looks like easy money, it's probably a good time to be getting out. And that was kind of looking like easy money then, I guess. And now it's clearly hurting people, despite the fact that the fundamental might be good. I mean, I can cite you hundreds of instances where the fundamental never changed from good to bad, but the market did, right?
All right, Jason. Well, where can people find you?
So we have a webpage, crowdedmarketreport.com, that you can check out. I'm also on YouTube. I do free videos on YouTube pretty much every week, and Twitter, and we have a Substack, crowdedmarketreport.com. And that's all free. There's multiple places you can check us out. But if you start at the website, then you can see all these other places are on there. So crowdedmarketreport.com is probably the best place to look at first.
Okay, we'll have the links to that down below. So be sure to check it out, guys, if you're interested. Also, hit a like, hit us a subscribe. If you enjoyed this content, go Jason, go in the comment section. And be sure to check out our Substack for the full interview with Jason. And also, you can see all of these interviews before the YouTube audience does, among a bunch of other features. So be sure to check out our Substack. A link to that is in the description box down below. And with that said, thank you guys for watching, and I'll catch you in the next episode. Bye, guys.
This is what contrarian is kind of all about, right? It's not, the market's not just going to go up because of the fundamental. The market goes up because there's more buyers than sellers, right? And if everyone's already bought, then where's the extra buyer coming from, right? Well, the market goes down and squeezes them out. Okay, now they're no longer in, so now there's money that can buy
The
it.
most contrarian position that you hold that most people tend to disagree with right now.
I would argue that the most contrarian thought process right here would be